Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. And guys, today I'm excited to welcome back a returning guest. He's been on, I guess it's been about a year and a half or so. Someone who's really made a huge impact in the passive investing space, the limited partner space, and continues to really be a leading voice for all accredited investors, limited partners, I guess non-accredited as well. And so Jim Pfeifer, excited to have him back here. Guys, for those that don't know, Jim is the co-host of Passive Pockets podcast. And, when we last spoke again about a year and a half ago, he, in that podcast episode, he really shared his journey. We talked about him transitioning from an active real estate investor to a full-time passive investor. And, since then he's been incredibly busy. He's growing his community left field investors, which and we'll talk about this today as well. It recently merged with Bigger Pockets to create what is now Passive Pockets. And so Passive Pockets is a network that really offers resources and helps empower limited partners, limited investors through, connection, education, and other various resources. And so guys, in today's episode, we're just going to be catching up. We're catching up with Jim to see what he's working on and what he's up to, since we last spoke. So without further ado, I'd like to welcome Jim Pfeifer to the show. My friend, how you doing today?
Thanks, Kevin. It's great to be here with you again. I'm basically on career number 6. When I first got out of college, I was a finance major, and my belief was that the way to build wealth was through investing in the stock market and mutual funds. And that's what I learned, and that's what I did for the first 25 years of my career. Eventually, in 2008, we had a child, another child, and outgrew our house and built a new house and had to sell our old one. And we couldn't sell it because, that was terrible market timing. But that's when we became accidental landlords. And it really opened up my eyes because at the same time, I was transitioning to become a financial advisor. And when you're a financial advisor, when you first start out, they pretend like you don't know anything about money. And so they teach you everything right from scratch. And so I was being retaught finance, but of course with all paper assets as the things we were looking at. But at the same time, I had this rental property. And although I hated being a landlord, dealing with the tenant, although I had a great tenant, I just didn't like, being on the hook for things. I saw what it was doing to my finances. And so I slowly started learning what they were teaching me and applying it to real estate. And we had that property paid off. So we went and said, well, we like the financial value that we're getting from this asset. So we refinanced and converted that one cash flowing asset into 3 rentals. So we had 3 cash flowing assets just from that one. And that's when I was learning about the power of leverage, cash flow, all this stuff that they were kind of teaching me on the financial advising side, but I was applying it to real estate. And so I didn't last long as a financial advisor because I prided myself in investing in the same things I was putting my clients in. Well, now I was pivoting to real estate. And as a financial advisor, I can't recommend real estate because I'm not licensed. I also don't get paid for it. And, most financial advisors are kind of afraid of it because they don't understand it. And so that's kind of the world of alternatives, which you're not going to get from your financial advisor. So that kind of led me down the path of becoming an active real estate investor. And so I started, what you do when you're active real estate is you brag about the number of doors you got, right? So I started buying single family homes. Then I said, well, let's get into multifamily, about a 22 unit, an 8 unit, a 4 unit. Pretty soon I had 40 plus doors. And I thought I was killing it. The problem was I was a terrible asset manager. So almost none of these properties cash flowed the way I had projected with my, Excel spreadsheet with 5% vacancy and all the other things that I didn't really know what I was doing. And I was constantly fighting the property managers because they wanted to evict people and do rehabs and fix up apartments. And I was like, well, that's not going to help with my cash flow. And so it was a constant conflict. Now, fortunately for me, although I wasn't a good asset manager, I had a pretty good luck in timing the market. And this was in the 2010s, 15s, when everything was going up. So all these assets grew in value. They never cash flowed like I wanted them to. And then I found this thing called real estate syndications. And that's when it really hit me. Like I can hire an asset manager to do all the stuff that I'm not good at. And all I need to do, and it's air quotes, a big all, right? I need to vet the operator. I need to analyze the deal. I need to think about the market, but I do all that up front. And then I send a wire and I have someone like you who their full-time job is to manage this specific asset, this specific asset class in this specific market. So they have a deep expertise that I cannot match. And what I found was the returns that I'm getting from this new type of investing for me into syndications was better than I was doing on my own. Because as an active investor, I didn't have a skill that set me apart. I couldn't swing a hammer better and do rehabs. I didn't have deep market knowledge or deep asset class knowledge. I just knew I wanted, to have these real assets producing real cash flow because I had learned in my mind that investing in paper assets is speculation, right? Because there's no current benefit. You invest in something, a piece of paper, a stock, electronic now, and you hold it and you hope at some point in the future you can sell it to somebody else for more than you paid for it. That's it. That's speculation, right? But if I buy real estate, I have a current benefit, hopefully, in cash flow. And then I have the hope that there's some appreciation on the back end. That's just the bonus. So it completely changed my way of thinking. And I dove all in to syndications and sold all of my active real estate, did what we call the lazy 1031, which is basically just using depreciation to offset the taxes on the new assets you buy. And so I just went all in to becoming a passive investor. And at the same time, I wanted to start a community. Well, actually, I was going to start a mastermind because when I was an active investor, I had a group of people, right, that helped me. And we did business together. We shared information and knowledge. So I want to do the same thing. So we started a little meetup. It was going to be 12 people having dinner in Columbus, Ohio, where I live. And our first meeting was March 18th, 2020. And if you can get out of the PTSD and remember what that week was, that was when the world shut down for COVID. So we didn't meet in person at dinner. We did this new thing called Zoom, and we met online. And that's when it took off. That we eventually became Left Field Investors, which, as you mentioned, is a community of passive limited partner investors where we just help each other become better investors. And we grew to about 2,000 plus members over a 4 or 5 year period. And then we got to the point where, we didn't start it as a business, but to run a community, you have to make money to pay the people that are doing all the work. And so eventually we realized that our resources were exceeded by what we wanted to do. We didn't have enough resources for the way we wanted to serve the community. And so we went and found the, Bigger Pockets, who has the biggest real estate community there is. They were looking to get into passive investing. And so we merged and created Passive Pockets. And that was a long story for my brief summary, but that's where we are now.
No, I appreciate the background, Jim, and the additional insight there. And I've actually had the opportunity to spend some time kind of being involved in Passive Pockets, and it's Left Field Investors, the same thing. We had an opportunity to spend time with you guys, get to know you a little bit, and it's been I think it's, at least through my lenses, it's been a great thing. Been a great merger and a great partnership, and an opportunity to really I guess just expand upon what this great foundation that you guys have already built. So I guess I'm curious to know, from your perspective, what new opportunities, has the Passive Pockets brand, or I guess Bigger Pockets, Passive, whatever you want to call it, but Passive Pockets brand, generally speaking, what has it opened it up for, as far as new opportunities for the LP community that you're serving?
Well, our goal was never to have the biggest community out there, right? We were always very proud. The most proud we were of anything about Left Field Investors was the culture of the limited partners. And that wasn't something that, the founders created. It was the people in the community created this culture of helping each other, being honest with each other, and just trying to figure out how do we go forward, right? But at the same time, it allowed us to get, hook up with operators who might give us better terms because we're buying in bulk, right? We can get a bunch of people together to put $1 million together to go into a deal, and the operator might give us better terms or better minimums, things like that. So it's always a balance. We want the community full of quality people, which honestly, I am always shocked at the quality of the people. We have forums, and there's no bickering or, the typical things you see on social media. It's just people helping people. So it's wonderful. Yeah. And so our goal is to keep growing it, because the more people we have in the community, the better chance we have of interacting with operators, getting quality operators who want to become part of the community that then will give us better terms and better access. So that's really some of the benefits that we've gotten so far, is that we're getting all these new operators that want to interact with us. We do deal reviews, right, where the operator comes on, as you know, and we ask you you kind of give a deal pitch, and we ask you all kinds of questions. We try to ask the tough questions to show our LPs, hey, you should, and you're allowed to ask the uncomfortable, difficult questions. And then we have our expert LPs kind of talk about the deal afterwards. And those are some of the things that, having the backing of bigger pockets with their reach, with the number of people that they have access to and the number of operators that they already know about, it just opened up our network. So our network's a lot bigger. It still surprises me how we get such quality people, but it's a mindset, and we're
Yeah.
about building wealth through creating financial freedom, whatever that means to you, to all these people with this specific way of investing. So it's very niche. So we'll never get really huge, but our goal is just to keep kind of building a platform that serves the limited partner investor.
Yeah, no, I love it. I love it. Let's talk about, I guess someone that's maybe tuning in that's just starting down their passive investing journey. I guess what's one piece of advice that you might give them before they write that or wire that first check into a sponsor?
Patience. Patience. I did not exhibit patience. And I was so excited when I found this. I chase the shiny object, right? I find something new and I'm like, man, this is the best thing ever. And, you don't have to jump into the first deal with the first operator you meet, right? I assume most of us, when we were growing up, we dated a few people, and before we picked the one we wanted to be with forever, right? These are long-term, illiquid investments that are completely out of your control. So it is like a marriage, each time you invest. And so for someone new, I would say, join a community. It doesn't have to be passive pockets, but the information you get is really, really helpful, because you won't know if you made the right decision for 5 or 7 years, right? Because
Yeah.
you won't be able to, because these take so long and they're illiquid. You can't get out of it like in the stock market. So having the patience to really pick your first partner and make sure they're a quality one, because if you pick someone and you lose in the first deal, you're probably not coming back. And I cannot think of a better way to build wealth than through real estate passively. And if you think about all the wealthy people you know personally or you know of, almost all of them, I would bet, created their wealth either by owning a business or owning real estate. And this is an
Yeah.
easy, again, air quotes, way to own real estate. So I don't know if I answered your question, but I would say
Yeah.
patience and community is what you need.
Well, let's expand upon that a little bit. So,
Yeah.
again, assuming that you have the patience, but you're still new at this thing. I mean, what are the top three things that you're looking for that for you would signify a great opportunity, a great operator, and someone that I want to basically spend my money with and essentially get married to for the next
Yeah.
5, 7, maybe 10 years?
Yeah, I think one of the things you really have to look at is track record. And I actually think it's going to be a little bit easier to assess an operator now than it
Yeah.
was 5 years ago, right? Because 5 years ago, as I evidenced, any idiot could make money in real estate, right? I bought properties and they appreciated, and I looked like a genius, and it was just because I was in the right place at the right time. Well, over the last 2 or 3 years, there's been a lot of challenges. So now you have better questions you can ask. Hey, how did you come through this? And 3 years ago, if someone had said, "Yeah, I did a capital call," I would have been like, "Thank you, I'm done." Right? There's no chance I would have invested with somebody that had a capital call, because that meant you were bad at this business. Because why would you need a capital call when everything was going up, right? But
Yep.
now there's lots of really quality operators who have had capital calls. So now the question is, why? What happened? How did you fix it? Where did it go? So you have a lot more information. So I think it's going to be a little bit easier, but I want someone that has a quality track record. That's number one. And
Hmm.
experience is probably number two, right? And those kind of go hand in hand. The other thing that I'm looking for, and this is where community comes in for me, is I don't invest with a new operator unless they're introduced to me by somebody I know, like, and trust in my community who's already invested with them. Now, that doesn't mean everything's going to work out rosy, but I'll tell you, that gives you, you're 100 steps ahead, because I still do all the same due diligence, but now I know somebody that is invested with you. So they can confirm, do you get reports like you say you're going to, like they say they're going to? Do
Yep.
you get distributions like they say they're going to? And if not, do they explain why? Right? It's not about whether I'm getting the distributions or not. It's about, are you going to plan? And if not, will you explain it? How do you communicate? That's one of the most important things. Again, I say it all the time. These are long-term illiquid investments, right? If you aren't, as an operator, if you're not going to return my phone call or respond to an email in a timely manner before I wire you $100,000, what do you think you're going to do after I send you my money,
Right.
right? It's going to be worse. So those are some of the things I look at, and it's really patience, communication, and community for me.
Yeah, there's a quote that I think of when you mention that. If someone's not really good with communication even before you give them money, what's it going to look like thereafter? And it's if someone tells you who they are, believe them.
Yes, yes, well
Simply
said.
put, right?
100%.
Yeah, and I think it's communication when things are good, right? Like that's easy. Giving good news is easy. It's like what happened, what happens when things are hard. There's bad conversations to be had, right? Because surely if you've been an investor long enough, you're going to have ups and downs. And if you say that you haven't, that means you haven't been doing it long enough, or you're full of shit. One of the two,
Yeah,
right?
absolutely.
Yeah, challenges come, and it's just how do we face that adversity and how we get through to the other side. Has anything in your personal investing strategy changed over the last year or two, given the market conditions?
Yeah, one of the biggest mistakes I made, I said kind of a little bit of patience, and this is related to it, was liquidity. And this was a big conversation in the 2000 teens. We in our forums, we would always be, what do you do with your cash? With cash drag, right? You got to be fully invested. You don't want to just keep it in a bank earning zero. Where do you put that cash? And so I was fully allocated to these real estate investments. And the thing is, you'd have these pro formas that were 5 years, right? Typically, an operator does a 5 year pro forma. Well, for a while there, all these deals were going full cycle in 2 or 3 years. So I started to rely on that, right? But then interest rates went up really fast. Operating costs increased because of inflation and insurance and other things. So now these deals that were going 2 or 3 years now might look like 7 to 10 years,
Mhm.
right? So where I thought all this liquid, I would have all these deals pumping out cash, and I would, it's kind of like a bank just churning out money. Now, all of a sudden, my money's locked up, and now I'm thinking, okay, I have life expenses. I have all these other things. Some of them are cash flowing, some are not, but I have almost no liquidity because I allocated all my capital, and that made me rethink, like, what am I doing with liquidity now? I have several places I store cash. And even if I'm in a, now you can get a little bit more than 0% on your bank account or whatever. But even if I had 0%, right? And I don't have to have all of my money earning a return. Sometimes just having cash in the bank earning 0% return, that is a return in and of itself. So I look at that. I also looked at, I used to say, once I got into this real estate, I was like, I'm done with the stock market. I don't need it anymore. Well, that's a nice place to put some liquidity, right? In an index fund or something. It's not going to go too terribly up or too terribly down, but it's a place to put cash and have return. And then I also have cash in, infinite banking type policies through life
Mhm.
insurance because that always gives you a return, and that is tax free. And you can, that's a really great place to store cash. So the liquidity and handling of cash is really one of the biggest lessons I learned through these difficult times.
Okay. Are there any sectors right now or asset types that you're really bullish on, that you might not have been a few years back?
Yeah, I think the one most popular right now is debt, for a lot of
Hmm.
reasons. It's in a little bit safer space, better in the capital stack, and you can get kind of quality returns. And I think, we've been talking more and more in our community about how it's a great beginner place. Like the first place you want to invest, debt. It's a little bit less risky. You get to see the returns, cash coming in pretty immediately. So I like debt. I'm not trying to pander here, but I really like what you guys are doing with mobile home parks and parking lots. So that was one of my recent investments was with you guys. I think there's a lot to be said there for the that asset class generally because the affordable housing is a challenge. I'm going to start creeping back into multifamily in very specific situations and markets. But really, my whole thing is diversification by market, by asset class, by operator, by type of debt, by length of investment. I'm trying to just diversify as much as possible because I believe that way, when things went bad in multifamily, I still had other asset classes that were, performing okay.
Yeah.
And that's what I want. I want diversification.
Yeah, no, that's great. Curious to know. I mean, you spend quite a bit of time with various sponsors. I mean, your Rolodex is huge, right? And so you've talked to a lot of sponsors. You know who's out there doing what in the space. What have you seen? Again, just from your perspective, as far as those that have had some challenges, and just because folks have had challenges doesn't mean they're a bad sponsor, right? Like this caught a lot
Right.
of folks off guard with the increase of interest rates at a rocket pace. But have you seen some of those that have had the challenges that are good sponsors having difficulty kind of getting back in? Are they still running damage control? Just you know, managing chaos, or are you seeing folks starting to step back in and buy again? And more
Yeah, it's
specifically, those that have had challenges, right? Those
yeah.
that had challenges the last couple of years.
It's really interesting because I think the ones that have been challenges, there's different types of challenges, right? Some I think had challenges that turned them they ended up doing fraud, right? So those are out. And
Hmm.
I don't think they meant to start out that way, but they just kind of got lost. There's others that had challenges and have not admitted they had challenges and are still kind of just plunging forward hoping. And then there's the ones that I'm on good terms with, which are the ones that have challenges, have acknowledged it, and are trying to move on. And I'm not seeing a whole lot of the third category really starting again with anything new. I think there's one operator that had they were basically apartment flippers, and I knew it, and they were making a ton of money until they weren't. And then their thing was, well, if the market changes, we'll pivot and we'll be able to ride it out. And they weren't able to, and they were arrogant and they weren't good to their investors. And they just came out with their first new deal in 3 or 4 years, and it's looking like it's going to be fully subscribed, which surprises me. But at the
Hmm.
same time, I'm hoping that they've learned and that they're gonna go for it. The challenge LPs have, right, is it's hard because if you call out these operators, then they might not be able to do new deals.
Yeah,
And then what happens to all your old stuff, right? Because now they don't have a legitimate business. At the same time, you don't want to rescue them. You want them to learn and get better, right? And so for me, I'm trying to focus on the anybody who had challenges does not mean I'm not going to invest with them again, but I want to hear what you've learned, how you've changed, and how you're going to do it better. But to answer your question, I'm not seeing a whole lot of any of those guys really into new deals yet. Now, the middle category, the ones that have pretended nothing happened and that everything's fine, they're still buying. And so it's interesting to see, are they going to be able to make it through because they never stopped buying? And there's a few of those out there as well.
how do you pretend nothing happened though, if it really did? How does that work? 'Cause
Um,
I feel like enough time has gone past to where, like, inevitably, the clothes will come off and you're naked, right? Like you can only
yeah,
hide for so long. But I'm just
yeah,
curious. I don't know if there's, we don't need to name specific names, obviously, but I'm just
yeah.
curious how one could fake it for 2 or 3 years.
Well, I think part of it is, people thought interest rates were going to go down, right? As soon as they went up, they thought, but it was 2025, they're going to go down. Now it's 2026, they're going to go down. So they keep just kind of they kicking the can down the road. And some of these I know the principals are funding, personal
Mm,
loans and things like that, trying to just see if they can get through it without having to do a capital call, seeing if they can get to the point where they can start again, having these things cash flow. And so I think that's it. They're
I
just
gotcha.
hoping.
What
Yeah.
I mean, have you and I personally haven't, but I'd love your perspective on this. I mean, I've got a few investments outside of Sunrise. I'm
Yeah.
diversified as well with other sponsors, and there's been a number of deals. And I'm not going to name names, but there's been a number of deals that have had capital calls over the past 2 years. And so, but I've kind of got my own thought process I go through and strategy of how I decide on whether or not I'm going to participate or whether or not I just kind of write it off. Yeah, it's hard to write. It's difficult to write off six figures, right? But like,
Yeah.
so you also don't want to throw good money after bad, right? That's really where the decision comes down. Do you feel as though you're throwing good money after bad? So, help me walk through that your thought process. Again, this is under the assumption that you've had a few capital calls and some of the
I
deals.
have.
Maybe you haven't, right? But
No, I have.
how have you made that difficult decision when that capital call comes?
Yeah, it's tough because at first it was kind of like, well, it says in the documents that when a capital call comes, that I have to participate. So okay, I participate. Right, that was the first couple small ones. Were like, well, it says I have to, not thinking that I don't have. Even if the documents say I am required to, I don't have to give them more money. Right, I might be diluted. There might be punishments and stuff, but if I'm already losing my money,
Yeah.
I don't have to. So that's the first thing as an LP. Understand that you have options.
Well, that's
But
good.
really,
I didn't think of that. That's great information because you're right. Some folks might read way too much into. I mean, they're legal documents, so like there are consequences if you don't pay in. But
right.
you're probably not going to end up in handcuffs and hauled off to jail if you don't, right?
Right, right. But the operator also says in the emails might say it's required. You have to participate. You still need to read the documents because that might not be true.
Yeah,
And they might not be lying to you. Sometimes they just don't understand their own documents, right? So it depends. But let's say it comes to me and I'm like, okay, I evaluate it as if it's a new investment because, as you said, I don't want to throw good money after bad. So if they have a plan that will take us through 5 years, 7 years, that this money will last, and they explain what's happening, they tell me the current status, what went wrong, right? And it's interest rates. It's not them operationally. If it's their operational, they didn't do the things they said they were going to do because they were not operating it efficiently, then I'm not going to give them more money, right? Because they're not going to do any better. What have they learned?
Hmm.
But if it's because of interest rates or insurance costs or all the stuff that's happened recently, and they have a plan and they can explain it and it makes sense, and I re-underwrite it as if I'm looking at a new deal, then I might participate. And there's one particular operator who had been warning about a capital call might be coming for about a year. And then when it came, sent out a 4-page deck. Here's how we're using the money. Here's what happened. Here's why, all the stuff. And I was like, I wrote the check the same day because it was just obvious they had thought it through. The plan made sense and everything was good. Now there's others who are just like, you got to give us money because we're running out of cash. And I've learned to, okay, I'm not going to just jump in on those, but it's really hard. I'm in one right now, and it's one of the ones that they push the can down the road, and not in a bad way, right? They use the operator used their own money to think they could get to 2025, and now because of tariffs and other things, interest rates aren't going down like they thought they would, and so they're at a place where they have to do capital calls now, and it's really tough because I'm listening to what they're saying. I'm not sure. And so I've been waffling. Wait, the date is today. I have to decide. And I've re-underwritten. I think it might get a chance, but it's such a slim margin. And then you look at it and they need X dollars and they have half of that raised. And so you're like, well, what's
Oh
the
boy.
point if they're not going to get there anyway? So it's a really hard one, but in a nutshell, I think you need to re-underwrite it as if it's a new deal and only do it if the reason for the capital call is not operator incompetence or operator underperformance. It's macro, economic conditions that cause the problems.
Yeah, no, all great points. I want to point out something that you just made a comment on. It's really, if they're calling for a certain amount, and they give an update, say they're asking for $1 million, just simple numbers, and they've only made it to call it 300,000, right? And like they're not getting traction after a number of emails, right? And you don't think they're going to ultimately ever even get there. Like my consideration and fear becomes if you inject your capital now, it's in there, it's in the capital stack, and inevitably you're probably going to end up losing that as well because they're going to burn through it and operating reserves and what have you, and still never make it to that finish line that they're shooting for, whether it's a loan extension or a
Right.
refinance or whatever end point they were trying to reach. And so no, but that's all great feedback. I mean, I have the same consideration. I've put money in about half, and I haven't in the others because the others I just didn't feel confidence how it was gonna make it anywhere, whether it be
Right.
operational confidence or just it's just too far. It's too far upside. Like a lot would have to go really positive over the next 2 years for the market to change that dramatically to add enough value to where it'd be right side up instead of upside down. So
Yep.
it's a tough decision. It really is,
It is.
because you never want to walk away from any amount of money, and then you also again even harder decision to throw good money after bad if that's how you're feeling about it, right?
Yeah.
Um,
And the way the operators sometimes react to it too, make you don't know for sure, but they're like, "Hey, if you don't do this, your equity is gone." Right? If we don't get this capital call, there is not enough there. The lender's just going to take it back and we have nothing.
yeah,
And so and I don't blame the operators necessarily. I think they're being honest mostly, but it puts the pressure on you like, "Oh my gosh, if we don't do this, we don't have a chance." Well, yeah, but even if you do it, you might not have a chance. And
that's
that's the
right.
evaluation, right? It's not just, hey, I'm going to lose 50 grand if that's what you invested, but now you're asking me to put another 10 in. Am I going to lose? I don't want to lose that also.
Yeah, I also want to know. I do want to know the sponsor themselves, right? Like how what's their personal financial situation? Are they support are they putting their own capital alongside the LPs? I mean, are they
Yeah.
looking to risk, risk their lifestyle, whether it be their home that they live in, their personal items, their personal bank account. Are they willing to? Because that's what we're doing, right? That's what, as an
Yep.
LP, you're doing just that.
Yeah.
All the money that you've worked really hard for, right? Because you believed in the deal, you believe in the sponsor. And so, is there an alignment there, right? Are they willing to walk that line with you, knowing that there's additional risk here and that we all might lose out on this? Or is it just the LPs lose out and the sponsors, it's a non-recourse loan and they walk away and they kind of wash their reputation's damaged, but they kind of wash their hands clean of it?
Right.
That's incredibly important to me as well. And so if you can
Yep.
find that out, it'll help you make a better educated decision, I believe.
Yeah, that's a great point. I would also add in fees. There's a lot of fees that go along with these operations, and the operators need the fees to run things. But I see a lot of operators who are doing capital calls, and they say we're going to suspend our asset management fee, or we're not going to take this fee or that fee because of the capital call, and so that they're sacrificing too, right? They're investing their own money in alongside you is super important, as you mentioned, but you're also restricting fees, or maybe you're giving, maybe it was a 75-25 split. Now you're going to change it to 80-20. You're trying to do right by the investor. And you have to look at all of that as well, because I think that shows that you're genuinely, whose side you're on.
And I want to be conscious of the time here, respectful of your time, Jim. There is one other question I wanted to ask. This is really related to new LPs that are, again, just go back and step in your own shoes back, whatever year it was that you made that first investment as an LP, right? And you've learned a lot over the years, but being a new limited partner, if they don't have a background in real estate, they don't have a finance degree, they're not a trained analyst, they don't get excited when you say the word spreadsheet, right?
Yeah.
How can, what's some advice you might have for new investors to get past the overwhelm of deal analysis? Again, and I think along with that goes sponsor vetting and even economic uncertainty or what's going on in the economy, right? But I think deal analysis is a big one. Like how does that newbie get some just general education and knowledge of how to look at a deal and even have a general sense of like, this looks good or this looks bad, or I've got questions about this line item, right? Like, where does that basic education come from?
Yeah, and again, I think it goes back to community, because the thing is, I probably put 80% of my time and effort into the operator and understanding them and getting to know them, and making sure that I trust them and they know what they're doing. And then I'm not going to re-underwrite a deal from scratch, right? Because you're the expert, you know more than I do. I've proofed you, I trust you, and so when I get a deal from you, I'm going to say, okay, I'm going to assume that this is probably a pretty solid deal. But then I'm going to go do some due diligence. So, for example, at Passive Pockets, we have a deal analyzer tool. It's just an Excel spreadsheet. You put in the pro forma finances, and it basically spits out red or green whether they fit certain parameters that we've kind of determined from, just our market knowledge, what cap rates are, or, whatever all the metrics are. And that it doesn't tell me whether a deal is good or bad. What it does is allows me to ask questions. Anything that turns red, I go and I ask the operator questions, which again lets me develop a relationship with the operator. There's also everyone's working on AI, right? Trying to have AI help out. And the way AI helps is it can just kind of give you additional questions and look for things if you and you have to practice and get the right prompts. But again, we're working on that in our community at Passive Pockets, and others are as well. So I guess the answer to your question, if you're new, I would concentrate on the operator first and make sure that I get that, and I find someone that I like. That's another thing that I just added to my sponsor screening, really, is I want to do business with somebody I like, because I'm going to be in business with them for 5 or 10 years, right? And you said it earlier, I might have to have a difficult conversation if things aren't going well. Well, if I can't stand the guy or gal, I'm not going to want to chat with them about it, right? But if at least they're likable and I can, see hanging out with them at some point, then that's the kind of person I'm going to invest with. But as far as the analysis, there's a great book by Brian Burke, The Hands-Off Investor. I think that's required reading for anyone who wants to get into this kind of stuff. And it just gives you a few things to look at. And I'll give you one example, and then I'll stop here. But like vacancy, I mentioned earlier, when I was an active real estate investor, I just put 5% vacancy, right? Well, for a single family home, it's either 100% or zero. But I would just, in my little underwriting, assume 5%. Well, once I started getting into syndication investing, I learned that there's economic vacancy, which includes more than just it being empty, but loss to lease, which means you're not getting the rent that the market's getting, or what are not accommodations, but when they don't, when you have to give like a free month or something.
A concession.
Thank you. Concessions. It's Friday. And so things like that, that's all in economic vacancy. And that number should be like 8 to 10%, depending on market and things like that. So when I evaluate deals, I have a few of these metrics that I'm like, oh, I look for how the taxes have changed. I look at economic vacancy. And once I learned a few of those, then I can look at just about any deal and look at the 3, 4, 5 things that are important to me that I've learned from using this deal analyzer and talking to people. And that's kind of just like a checklist to help me get through the analysis. But I am not going to dive in as if I'm buying this on my own, right? That's why I'm
Yeah.
hiring the asset manager.
Yeah, no, that's great advice, great feedback, and guys, well, Jim, is that a free item that they can download on the website as well? The deal
Yeah, so
analyzer.
it's you have to be a member of Passive Pockets, but
Okay,
fortunately you have a 7-day free trial, so
there you go.
you can jump in there in the first 7 days. You can download it and check it out, and it's super helpful in my opinion.
Where can folks go? Is it passivepockets.com?
Yep, passivepockets.com.
Okay. How about Jim? For those that want to learn more outside of Passive Pockets, I mean, are you on LinkedIn? You on different social channels where folks can reach out to you, and if they want to ask you questions about your story, your background, or anything in between, is there a good place to contact you?
Yeah, absolutely. You can. I'm on LinkedIn at Jim Pfeifer. You can also email me, Jim Pfeifer at biggerpockets.com. And if you join Passive Pockets, you can send me a direct message. I'm on there as well. I really enjoy talking to new investors and LPs. So that's
Yeah.
what I do all day. So I'm happy to schedule a call with someone if they send me an email and want to chat.
Fantastic, my friend. Well, it's always a pleasure. Always enjoyable to chat with you. Appreciate you sharing some of your background, your story, and just general knowledge of the passive investing space. I mean, you've been doing it for quite some time now. You've spoken with, hundreds of probably thousands of sponsors now, and lots of
Yeah.
LPs, both new and experienced. So again, just appreciate your insights and all the value that you bring. So, folks, we'll put all those links in the show notes. And with that, my friend, I'll let you get back to your Friday. But I appreciate you coming on.
Thanks, Kevin. It was a pleasure.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.